Top 10 personal finance tips for young adults. Being young and financially stable are not mutually exclusive. In fact, there are many things that young adults can do to set themselves up for financial success in the future. What is the best financial advice for a young person? Here are 10 financial tips for young adults. Number 10. Create a budget and stick to it. Making a budget is similar to creating a lifelong financial roadmap. Understanding your income and expenses is the first step. Begin by enumerating all of your sources of income, such as your salary, any side gigs you take on, and any other recurring income. Next, list every expense you have and categorize it into groups such as debt payments, utilities, groceries, transportation, entertainment, and rent or mortgage. Set limits for every category in accordance with your financial priorities and goals after you have a clear picture of your cash flow. This could entail making compromises and changes such as limiting eating out in order to save more for a trip or cutting back on discretionary spending in order to pay off debt more quickly. The secret to a successful budget is consistency and discipline. To stay on track, keep a regular check on your spending with tools like spreadsheets or budgeting apps, and make necessary adjustments to your budget. You'll feel less stress, have more control over your money, and be closer to your financial objectives if you follow your budget. Number 9. Build an emergency fund. Establishing an emergency fund is the first step towards safeguarding your financial future. This fund acts as a safety net, giving you a buffer to deal with unforeseen costs or financial difficulties without forcing you to take on debt with high interest rates or abandoning your long-term financial objectives. Aim to save enough money to cover 3 to 6 months' worth of living expenses before beginning to build your emergency fund. Compute your monthly essential costs, such as rent or mortgage, utilities, groceries, insurance premiums, and any other bills that are necessary. To find your target savings goal, multiply this amount by the number of months you wish to save for. Once you've determined your goal, open a different savings account that you will use only for your emergency fund. To see your money grow over time, think about selecting a high-yield savings account with competitive interest rates. Next, create a consistent savings schedule by setting aside a certain amount of every paycheck for your emergency fund until you achieve your target. Maintaining consistency in your savings endeavors can be facilitated by automating this process. Number 8. Start saving for retirement early. One of the most crucial financial decisions you can make as a young adult is to begin saving for retirement as soon as possible. Because of the power of compound interest, you have more time to see your money grow rapidly over time if you start saving early. When you start contributing to retirement accounts in your 20s or 30s, such as a 401k or an IRA, you give your investments decades to compound, which could lead to a sizable accumulation of wealth by the time you reach retirement age. Employer-sponsored retirement plans are a desirable alternative for retirement savings because they frequently provide extra benefits like tax breaks or employer-matched contributions. Utilize any employer-matching contributions that are available. They are essentially free money that can significantly increase your retirement savings. Furthermore, contributing to retirement accounts like traditional or Roth IRAs allows you to further diversify your retirement savings and take advantage of potential tax benefits. Number 7. Avoid high-interest debt. Achieving long-term financial goals and preserving financial stability require avoiding high-interest debt. Payday loans, credit card debt, and high-interest personal loans are examples of high-interest debt that can quickly mount up and become too much to handle, making it difficult to move up in one's financial standing. Since these debts frequently have high interest rates, you will ultimately pay a lot more in interest over the course of the loan than you originally borrowed. Living within your means and only making purchases that you can afford to pay off in full each month are crucial steps to take to prevent high-interest debt. This entails making and adhering to a budget that places a higher priority on necessities and reduces spending on extraneous items. If you must borrow money, look into lower interest choices like bank or credit union personal loans, which typically offer more favorable terms than payday lenders or high-interest credit cards. If you have a high-interest debt that you would like to pay off as soon as possible, your goal should be to reduce the total amount of interest that you pay over time. To prioritize paying off debts with the highest interest rates first and making minimum payments on the remaining debts, think about utilizing techniques like the debt snowball or debt avalanche method. To free up more cash for debt repayment, try to find methods to increase your income or lower your expenses. You need to be financially aware and disciplined to stay away from high-interest debt. It's critical to monitor your spending patterns and refrain from impulsive purchases that might rack up needless debt. Making wise financial decisions and placing a high priority on financial responsibility will help you steer clear of high-interest debt and work toward creating a solid financial foundation for the future. Number 6. Invest wisely. Making intelligent investments is essential to long-term wealth creation and financial security. Whether you're aiming for other financial objectives, saving for retirement, or creating an emergency fund, investing enables your money to increase and compound over time. But it's crucial to approach investing thoughtfully and with a firm grasp of your financial goals, investment horizon, and risk tolerance. Diversification is essential for minimizing risk and optimizing returns when investing. Invest in a variety of asset classes, including stocks, bonds, property, and commodities, to lessen the impact that market swings will have on your portfolio. If you have a longer time horizon for your investments, think about it and modify your asset allocation accordingly, placing more of an emphasis on growth-oriented investments like stocks. Investigate various investment choices and think about consulting a financial advisor or learning about investment concepts and strategies online. Recognize the expenses related to investing, such as commissions, fees, and taxes, and select investments based on your risk tolerance and investment goals. Keep up with market and economic developments that may have an impact on your investments as well, and be ready to modify your portfolio as necessary. Although investing entails a certain level of risk, it also has the potential to yield substantial returns in the long run. Remain disciplined and refrain from acting rashly on the basis of ephemeral market changes or gut feelings. Rather, concentrate on a diversified portfolio and a long-term investment strategy founded on reliable principles. By making prudent investments and adhering to your financial plan, you can endeavor to meet your financial objectives and accumulate wealth for the future. Number 5. Live below your means. A key component of personal finance is living below your means, which entails saving more money than you make and putting long-term objectives and financial security ahead of short-term pleasure. You can create a strong financial foundation for the future and steer clear of the traps of overspending and debt accumulation by adopting this mindset. Living within your means necessitates self-control and deliberate spending and saving decisions. It entails setting limits on unnecessary luxuries and discretionary spending, separating needs from wants, and giving priority to necessities like housing, utilities, groceries, and savings. This might entail short-term sacrifices like cooking meals at home, rather than frequently going out to eat or driving a used car instead of purchasing a new one, but the freedom and financial security that come with time outweigh these short-term drawbacks. You can build wealth and reach your financial objectives by continuously living below your means and investing the difference. You'll also feel more at ease knowing that you're ready for whatever the future may bring. Number 4. Stay educated about personal finance. Invest some time in educating yourself on personal finance subjects like debt management, investing, and budgeting. Many online courses, books, and websites are available to help you become more financially literate and make wise financial decisions. Number 3. Protect your credit score. Your ability to borrow money, rent an apartment, or to even get a job is all impacted by your credit score, which is very important in your financial life. To keep your credit score strong, pay your bills on time, don't take on too many credit card debt, and refrain from opening too many new accounts. Number 2. Set financial goals. Whether your financial objectives are to pay off student loans, save for a down payment on a home, or take a global vacation, having specific goals will keep you motivated and focused. Divide your objectives into more manageable chunks and monitor your development as you go. Number 1. Don't neglect insurance. Having the appropriate insurance coverage can save you from financial ruin in the event of an unanticipated illness, injury, or accident, even though it may seem like an unnecessary expense when you're young and healthy. Or to protect your finances in future, think about getting health, renters, auto, and disability insurance. So this is the end of our today's video. If you like it, then hit the like button, give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.